today. A lot of great things to look forward to. But first up, we have a panel that's going to be discussing the turbulent times that we've seen with initial coin offerings of late that have left many companies wondering, how can I issue these tokens in a way that's not going to get me in trouble with Johnny Law? As it so happens, that's exactly what our next panel will be discussing. Moderating that panel, we have Andrew Dix, who is the CEO and founder of Crowded Media Group, which runs Crowdfund Insider, a leading news and information source for global fintech. Please welcome him to the stage.
Excellent. First of all, I want to thank everybody who's here who made it back after lunch. I also want to thank the StartEngine team, Ron and Howard, for putting this event together. I mean, it's really a phenomenal, excellent event with the quality of people that are speaking here and the streamlined organization. So I really appreciate that. So you guys came to the right event here. To get this started, we've got a really fascinating topic. Talking about the hot area of STOs, ICOs, and how you do it in a regulatory compliant fashion. And I'm going to ask each of our panelists here to do a quick introduction of who they are so you have a better idea what their perspective is. We're going to start with you, Mark.
Yes, hi, I'm Jeff Marks. I've got a law firm called Alliance Legal Partners. I'm also an entrepreneur. And I've been in the crowdfunding space and the token space since the beginning, thanks to Howard and Ron. I've worked on I've worked on the Kodak One deal and Crown Throne, who's presenting today, and lots of little Reg CFs, and also working on a Reg A Plus, which we're hoping will be the first or one of the first that gets approved as far as a token Reg A Plus offering by the SEC.
I've heard that like 10 times now. We're going to be the first, but anyway.
One of the first.
One of the first,
yes.
yes.
Hey everyone, my name's Andy Bromberg. I'm the president and co-founder of CoinList. We're the platform where the best digital asset companies manage their token sales and airdrops. We've worked with customers like Filecoin and Blockstack, Props, Origin, Trust Token, Definity, and dozens of others.
Excellent. Mason.
Yeah, my name is Mason. I'm with a company called Tokensoft, and basically we help issuers onboard their investors or purchasers while remaining within the relevant compliance requirements when it comes to banking, securities, and tax laws. And we help them do this either from a US perspective or an international perspective. So for our funds in particular, we're helping them comply with unique securities laws in about 56 countries.
Excellent.
And I'm Josh Amster, and the Vice President of Sales at StartEngine. Hopefully, you guys know what StartEngine is at this point. If not, we're an equity crowdfunding and a STO platform.
You guys are in trouble if they don't.
Yeah, exactly. So I think everyone gets it.
Yeah, cool. So if you guys are interested in this space, you really, these are the guys that are making it happen today and now and actually executing. So you're really in luck for this panel. I was asked by one of the panelists to do a quick overview of the securities exemptions very quickly because I know that it gets confusing at a time. When you issue a securities, whether it's digital or not in the United States, for an exempt offering, you can use Reg D, Reg CF, or Reg A+. Reg D under 506C, you can actually generally solicit, which is SEC speak for advertise. You can raise as much money as you want from accredited investors. There is also Reg A+. You can raise up to $50 million from anybody. It's kind of like a mini IPO type structure where it's costly to do, but you can immediately trade the security after the fact, which is a reason why a lot of the ICO, STO space is very interested in it. And then there's Reg CF. Reg CF you can raise from anybody, but you can only raise up to $1.07 million. So those are the exemptions you have to work with. Yes, there's some interstate offerings we're not going to touch on. And yes, you can raise money outside the US, which I don't know if we're going to go there. But I want to get started by asking Andy a quick question about the difference between doing an STO and an ICO, because I get this question a lot and we deal with it. There's a certain element of confusion, and so I'm going to ask the expert to explain it.
Sure thing. Yeah, I think before saying anything here, the caveat is that the space is very young, as we all know, and the terms are still becoming clear, and so a lot of people use these in different ways. But the way that we think about it, I think it's important to take a step back first. There's two regulatory classifications that matter. One is what you're selling at the time of the offering, and the other is the intended eventual regulatory status of what it is that you're selling. Let me unpack that a little bit. For example, Filecoin, which is the project that CoinList ran, sold SAFTs, simple agreements for future tokens. And these documents are securities, unequivocally securities, that need to be sold in a securities offering like the ones that Andrew was just talking about. But Filecoin itself is intended to eventually be a non-security. You'll hear the term utility token thrown around, so something that is not classified as a security. And these SAFTs, which are securities, eventually output Filecoin, which is not a security. So those are two different things, what it is at the time of the offering and then what it is eventually intended to be. A lot of ICOs, and in fact, if you listen to the SEC chairman, he said many times he hasn't yet seen an ICO that isn't an offering of securities. But that does not mean that the eventual status of all of these tokens will be being securities forever. It just means that at the time of the offering, all of these have been securities. And so to answer the question more directly, I think of STOs as a subset of ICOs. An ICO is an offering of what I see as almost always securities. And what ends up coming out on the other end could either be something that's not a security, like Filecoin is intended to not be a security, or it could be a security token, a token that is intended to always be a security. And that's where you're thinking about a lot of things you've heard about today, whether that's real estate tokens or other asset-backed tokens, where the token is always intended to be a security. An STO is an offering specifically of something that is intended to always be a security. So Filecoin, even though they were selling securities at the beginning, is not an STO, because eventually that's intended to be a non-security. STOs are specifically the ICOs where you're offering something always intended to be a security. So STO, a subset of ICO, based on understanding what the eventual intended regulatory status is going to be, rather than what it is at the beginning, which in our eyes is almost always, if not always, a security.
Absolutely. So he nailed it. There's going to be a quiz later, so hopefully you guys took notes on that. Josh?
Yeah.
So can a utility token exist?
Absolutely. I think a utility token can definitely exist, although I don't think we've seen any utility token ICOs really to date in the States. Everything has had no utility at the point of it being issued. So, you get this token, you want to go and utilize it on a platform, and you can't. There's nothing you can do with it. So it's an option at this point. These ERC20 tokens that are securities that people have been getting, because they can't go and utilize these anywhere at the current time. Now, later on, that token will be swapped, hopefully, eventually, for that utility token whenever it's built and created and can be utilized. But everything that you've seen thus far really has been a security. It's been speculative, and a lot of people that have been purchasing these tokens are expecting a profit from it. So, those two things right there classified as a security. And just going back quickly to, what Andy said, I think there's still a big question out there as to how will the SEC look at these securities that are tended to become utilities down the line. Once you're registered, as a security, can there be some sort of magic trick where you now are no longer a security?
Magic, I like that.
You know what I mean? So
that'll sell well as a commission.
It's a question. It's an uncertain ground, I think, at this point. And yeah, there's a lot of kind of things to be aware of.
No, you're 100% right. And yeah, do you want to?
Yeah, I was just going to say, the purest form of a security token is what we're really just talking about is common stock that happens to be in the form of a smart contract. I mean, that's really kind of the purest form of a security token. And with SAFs, I just want to add what you're essentially, first of all, companies that offer SAFs don't necessarily have the token developed, but SAFs, as Andy said, are securities, but it's also a way to kind of kick the can down the road a bit, such that by the time the tokens are available for release, it's possible that based on the regulatory interpretations and how the platform is functioning, that you've got a good argument that it's a utility and not a security.
It's still a little bit opaque. The SEC has been very good at kicking the can down the road. Mason, you have a little bit different perspective because you actually worked on some extra territorial offerings and done some stuff in the utility space, haven't you?
Yeah, so we basically allow our issuers to have bespoke compliance requirements. So what we're seeing in the space is every issuer is working with a lawyer that's thinking a little bit differently. And so some people are looking at this from a very US perspective. Some people are looking at this from a very international perspective. They'll want to follow the laws uniquely per jurisdiction. And then there's folks that are overseas that are seeking to basically block US purchasers from the sale. What that does post-issuance, I can't really say, but it is possible. We have had a few clients that have basically chosen to block U.S. purchasers. So that is something that's happening that is possible.
But that doesn't always work. You have to be really careful because it'll get you, right?
Yeah, there are a lot of nuances. So I usually don't recommend it. I usually recommend that people do follow U.S. laws and just fit into them. But that is something that we're seeing in the space as the space is maturing.
Just the past couple of weeks, we've had a couple of state securities regulators gun for and issue some C&Ds for, I think, like 6 ICOs, and I don't think any of them were based in the U.S. So they're happy to go after anybody wherever you are. So you do have to be careful there. So blockchain securities. Where is the value? I mean, why do I want to issue a security on the blockchain? Andy, I mean, why do you want to do this? Where's
Yeah,
the
I
value?
think there's a lot of reasons, and I hate to give reading assignments up here, but would highly recommend a piece that a great professor named Steve McKeon wrote from the University of Oregon called the Security Token Thesis. It's on Medium. You should check it out. But there's a kind of an accumulation of reasons, and a lot of it drills down to making more liquid, more efficient markets for securities that don't have hyper-efficient, hyper-liquid markets today. An interesting piece of this is that one of the core benefits of tokenizing securities is that they become interoperable. All of a sudden, when a bunch of securities are issued on the same standard, they can interoperate with each other. You can have contracts that reference multiple different tokens, multiple different assets, and have them play off each other and start to structure really interesting financial products on top of these individual assets that have been tokenized. So you can imagine, for example, that today, if you want to invest in downtown LA real estate, you can invest in a REIT that some bank or other financial institution has structured and put together, but you're going to be paying serious fees to that institution because they had access to go and buy 100% or 40% or 20% of those buildings, and a lot of them, and then put them together in a REIT that you can go and buy $100 worth of or $1,000 worth of. And so you're paying fees for that, and you can only access an accumulation of assets that was picked by that bank, by that institution that decided to build a REIT. When we reach this tokenized future where you can imagine a world where every building in downtown LA is tokenized, you can start to build that yourself. So you can go out and say, I want to buy 1/100% of the assets or the income or whatever it may be of each of these buildings in downtown LA because I'm long downtown LA real estate. And once you do that, you've effectively structured your own REIT and only had to invest $100 or $1,000, and there was no intermediary sitting there charging fees for you to participate in that. And then even better, you can customize it. So if you're looking at it and saying, I want to go long downtown LA, but I've got a really bad feeling about this one building over there, this one very specific section of downtown LA, I want to exclude that from the purchase, you can choose not to purchase those tokens for those buildings and just purchase the tokens for the rest of downtown LA. And that starts to enable a really liquid, really efficient market where every market participant is both not paying fees to middlemen and also buying and selling exactly the assets they want to instead of arbitrary combinations that are enforced by intermediaries. So that's one of the benefits, I think, is this interoperability, the combinations of these different asset-backed tokens and securities tokens that can enable really compelling financial products for every participant in the market.
Josh, you were nodding your head over there. You 100% agree?
Absolutely, yeah. I think it's really allowing for just transparency and easy access to liquidation. So that's, Andy hit it right on the head. And I think when you can tokenize, buildings and art and racehorses, these hard assets that you can't easily trade and access, that's where this really becomes fascinating. And we've seen now at StartEngine a few companies raising money on racehorses, things that you just wouldn't predict or see commonly.
And people are investing in the racehorse.
Yeah, exactly.
A 1,000th of a racehorse.
Yeah.
All right. Okay. All right, that's cool.
Yeah.
So you're putting these deals together. What's your point of view?
As far as just on the whole blockchain,
Why do it on blockchain? Why issue security on blockchain?
it's immutable. There's a record of it.
What about back office stuff? Can we streamline a lot of that back office stuff?
Some of it's streamlined, but at the end of the day, you still, if you're complying with the securities laws, you still need a transfer agent. You still need to run the KYC, KML checks.
Okay.
And so, yes, it's easier to transfer the tokens back and forth, but as it stands now, you still need a lot of these intermediaries.
Okay.
You know, to get involved.
I don't like the intermediaries. I'd like to cut them
I
out
don't
as
like
much
the
as possible.
intermediaries either.
It's just a fee. It's paying a
Yes.
toll. Those guys suck.
Yes.
So Andy, we were talking about this just a little while ago about doing this internationally. So when I talk to the platforms, the ones that are established, these guys here, they're all looking at this as a global play, right? And why wouldn't you? Because in the blockchain, it gives you more power and potential to manage jurisdictional nuance, right? And I think all three of you guys are kind of looking at this, and you had an interesting spin on this.
Yeah, so in the early days of the ICO market, a lot of people relied on a regulation, a securities law exemption to sell securities called Reg S. And Reg S is a US exemption. And how people interpreted it was, if you sell to only international investors, don't worry about securities laws. That is not what Reg S says. What Reg S says is, if you sell to non-US investors, this tranche of tokens, and you restrict them from entering the US for a certain period of time, don't worry about the US securities laws for selling things, for selling securities, but worry about the securities laws of each jurisdiction that you're selling to. So if you've got a purchaser in Germany or a purchaser in Singapore or a purchaser wherever, you have to go and look at that individual country's securities laws and make sure that that person is allowed to purchase those securities. And something Mason said when he was introducing himself, which I think is so key, is said, you know, we cover 56 countries or whatever it was. That the reason he didn't say we cover every country in the world is because it takes a lot of work to analyze every single one of these countries. And you know, a year or two ago, these non-compliant platforms were saying, we'll let you sell to anyone because it doesn't matter. You just don't have to worry about securities laws. And the answer is you actually have to do in-depth legal analysis on every single one of these countries. We're the same way. Roughly the same number of countries that we cover, that we've actually analyzed every single one and said, if you're selling to a German investor, here's the flow they need to go through. If you're selling to a UK investor, here's the flow they need to go through. If you're selling to a Singaporean investor, here's the flow. And so when you're selling to international investors, as a US issuer, you often go through Reg S and you go and make sure that every single investor is abiding by the laws of their own country. And if not that, you can fall back to other US securities law exemptions, but you really have to be paying attention to each of those international sets of laws, not ignoring them wholesale.
Yeah, that didn't work out for some issuers who didn't abide by
Yeah.
that. Yeah, they had a bad day.
And it's the same with Reg A Plus, for example.
Yeah.
And what I tell my clients is, you know, they always say, can we take money from international investors? And, you know, I say, you know, look to see how much money you've gotten from a specific country, you know, and if it's less than $10,000, forget about it. But if it's a substantial amount, then you got to go and really look at the laws of that country before you take those investments. And that's really important because you want to be able to travel to various countries throughout the world without getting arrested. So.
Yeah, you don't want to be arrested in certain countries.
Yes.
That's right.
That was a
yes.
joke. Ron.
You would look great in orange, though.
Thanks.
Mason, you're already doing this, right? Tell me, how's it working out?
With the country by country?
Yeah.
So yeah, I think there's definitely a lot of challenges. The securities laws get really, really intricate, especially when you go overseas, and they're all very different. And so I think we've sort of operationalized the onboarding on a country by country basis at this point. The fun part is after the issuance is over, because there's special restrictions that are necessary after issuance. And so we've had a little bit of fun trying to figure out how to do exactly what the lawyers are telling us to do for those cases. So we recently launched a standard called ERC 1404, which helps us manage the compliance requirements during trading. And so if there are certain investor limits per country, or if certain regions aren't supposed to trade with other regions, and usually the case is US persons shouldn't be allowed to trade with non-US persons, we can help automate and manage those types of restrictions.
And this is huge because you think about it, the traditional way is you call up Goldman Sachs or some other investment bank and you pay them millions of dollars to do something that they boilerplate, as opposed to having it baked into your process. And that's big because that makes it so much easier to actually issue a security in a different jurisdiction and raise money from people wherever they are in a compliant fashion. I mean, that's kind of a game changer. Isn't it, Josh?
Yeah, absolutely, absolutely. And I think, you know, it's complicated. And a lot of the times, like these guys said, you know, every country has unique rules itself. Some, you know, that are only specifying towards accredited investors. So what do you do about non-accredited investors? And you just have to be very, very careful when you're going abroad to bring on investors. So, you know, it's not as simple as just opening up to them. And a lot of the times, these international countries, what they do is they look to the U.S. and the SEC as to what is the SEC
Absolutely.
doing.
Yep.
So they're the standard.
One more thing I should throw in is, you know, a lot of people come to me and say, well, we can just set up our company in Malta I mean, the bottom line is if you're selling to U.S. investors, it doesn't matter where you are, you
Yeah,
got to
you're
comply
toast,
with the
yeah.
U.S. laws. And yeah.
Massachusetts
Yeah.
will be pounding at your
Yeah,
door.
yeah, yeah.
They do that sort of thing. So liquidity. Liquidity is another big thing that we've spoken about several times today already. And you guys are, Josh, you guys are launching your own platform. I know that you guys are all working in it different ways. You know, how do we drive the liquidity for these blockchain-based securities? Josh, because you guys kind of announced you're doing your secondary market today. Do you want to talk about that?
Yeah, well, you need a lot of investors to have a market, right? So you need thousands of people involved to really create a liquid market. And one of the issues that companies are experiencing right now is 12G. And what does 12G say? Well, if you have over 2,000 investors or over 500 non-accredited investors, then you have to be a fully public reporting company, which is very expensive. And so a lot of companies are like, I don't want to get involved with that.
It's a trap.
Yeah, it's a trap. But if you use Reg CF or Reg A+, there's an exemption to 12G. Now, you have to have less than either, it depends on the law, either 25 million or 75 million in assets. You need to be ongoing with your reporting, and you need to have an SEC registered transfer agent. And so StartEngine is also a SEC registered transfer agent with StartEngine Secure. And so now you've gotten the exemption. So you can bring on tens of thousands of investors through Reg CF, Reg A+, and now you've got your tokens in the hands of all these people. And now there's a market, now there's liquidity, now there's trading. And that's what's so exciting about this. So while there appears to be a hiccup with 12G, it's been solved. And those exemptions have been put into both Reg CF and Reg A+, to allow for thousands of shareholders on a cap table.
Andy, how are you guys going to manage the liquidity?
Yeah, so there's a couple pieces here. One is from a regulatory perspective, what you are allowed to do and what you're not allowed to do. Josh is exactly right about Exchange Rule 12G. The specifics of that are that it applies to holders of record, which is most commonly classified as people that own equity in a company or some sort of security. The idea is that a lot of these tokens that are not securities, that end up not being securities at some point in the future, those will not fall under 12G. So you can, of course, have more than 2,000 or 500 holders of that, depending on what you're falling under. But Josh is exactly right. There are carve-outs for 12G, even for holders of record, if you offer the asset in a specific way. But from CoinList perspective, we're in the process of building out a secondary trading venue and marketplace to enable liquidity for these assets. And at the end of the day, when you build a secondary trading venue, you need three things to be successful. First, it needs to be compliant. You don't want to get shut down. Second, you need supply-side liquidity. You need assets to list on the platform and be exchanged. And third, you need demand-side liquidity. You need investors on there, to Josh's point, that are willing to go and participate and trade these assets. And from our perspective, we're really, really well positioned for that. Highly compliant platform, like all the folks up here are. Second, access to assets. It's really important to have these assets. And if you're conducting primary issuances for them, that's a great right into it. And third, you have to have investors on the platform. And CoinList now has tens of thousands of accredited investors on the platform ready to trade. So
that's how you're going to drive the liquidity by your existing and growing investor base? That's
exactly. And we'll be attracting a number of other investors to the platform as well to participate in those secondary offerings.
Okay. Mason, you're not doing any liquidity. You're working with other platforms, or are you doing liquidity?
Yeah, at the moment we're just focused on the issuance side of things. That's where we found is our sweet spot.
Okay. Are you going to get into the space? Are you one of the platforms that's going after an ATS?
No, we're
not yet. All right. I had to ask. So what type of issuer should consider doing an STO? Because you guys are all doing it. You're putting these together. We're going to start with you, Josh.
Yeah, I think people assume you have to be a blockchain-oriented business, and you really don't. You really have to look. You have to want to tokenize your security. You have to tokenize your equity. You want to tokenize, a debt instrument, something along those lines. And if that is of interest to you, which all the entrepreneurs in the crowd are looking to raise capital, then you're right for an STO. And all you need to do is come to a platform like StartEngine or CoinList or Tokensoft and do these raises. And these platforms are going to help facilitate that for you. They have a community of investors. They kind of steer you in the right direction as to what exemptions you should be using. And then those securities are going to become tokenized. Alan was up here on stage earlier talking about StartEngine Ledger and ERC 1450 and how we do that. And then those tokens are going to be traded on a secondary trading platform, an ATS, like StartEngine Secondary we're planning to do, and Andy mentioned with CoinList as well. So you don't need to be blockchain oriented. And I just want to reiterate that. It's not a requirement at all. It's really about, do you need access to capital, and are you interested in liquidity for your investors? And if that's true, then this is a space that you want to play in.
Cool. Mason, you've done a lot of SEOs, right?
Yeah.
One of the most. Yes?
Potentially, yeah.
Potentially, yes. So what's your point of view? You have experience.
So I think, yeah, so what we've seen is the market's still generally young. People figured out that these should be launched as securities late last year. And it was early this year that it became the standard or the best practice to launch your tokens as security tokens. And I think one thing that a lot of people don't realize when they enter the space is doing a security token offering is a lot harder than doing a traditional round. And the reason is not only is it hard to attract the investment as it traditionally is, but the infrastructure also is still very young. So there's maybe just 2 exchanges that can support these security tokens in the US. None of them have much liquidity. And so there are a lot of risks when going the security token route. And I think that's one thing that's very understated in the space.
Early days. It's
Early
still very
days,
much
yeah.
evolving. Andy, I know you guys are like giga selective, and you've done some cool offerings. I thought Filecoin was very cool. I mean, who should be issuing an STO?
Yeah, so again, when I talk about an STO, I'm talking about things that are always intended to be securities, so often asset-backed tokens that are intended to always stay as securities in that regulatory status. And I would maybe go a little bit against the grain here and say very few people should do STOs, which I know is not necessarily talking my own book here. But when you run an STO, you lose a base of investors that might have been interested in the asset but are not willing to invest in a token, which today is a significant number of investors. We are early in this token economy, and there are a lot of investors that aren't comfortable for reasons either kind of because of lack of understanding or because of legal reasons, because they have issues with custody or other problems that they may not have solved yet. So when you decide to tokenize your asset instead of selling the asset normally through a more standard securities offering without a token involved, you lose that base of investors that are not willing to invest in tokens. What you gain is perhaps a group of investors, many of whom might be in the room today, who are really interested in crypto and want to support the emerging security token ecosystem that might not otherwise have invested in or had access to your asset. But the algebra you have to do is that worth it? Is the loss of the investor base that you could have had worth the gain of the investor base that you're going to get when conducting this offering? And because so few things are tokenized today as securities tokens, a lot of those kind of accretive benefits when there's a big ecosystem of securities tokens don't exist yet. And so you really have to believe that for that primary issuance, it's going to be more beneficial for you. And I think that's true for a very, very small number of assets today. And I think as every month goes on and there are more and more securities tokens out there, that number of assets for whom it makes sense is going to increase. But today, I would say it's very limited.
Excellent. Final
I
words?
got nothing new down on this, but I just want to say one of the biggest misconceptions I get is people think about selling tokens for raising money, but people don't think about, people have business plans that incorporate the use of tokens on those in those business models, issuing tokens to contributors, and people are not thinking about the fact that at least right now, a lot of those are securities issuances, and companies have got to be mindful about how they do that and how they issue tokens to contributors and how tokens are exchanged in their contemplated business model. It's something that needs to be looked at and thought about.
Excellent. So a big round of applause for the panel, please. My time is up. Thank you very much. All right, guys.